Hello and welcome to the Finance Magnets Virtual Summit Industry Leaders Panel, Key Insights from the Front Line. My name is Ben Myers. I'm the head of news at Finance Magnets, and it is my privilege and honor to host and moderate this Leaders Panel for the first time. With me today are some absolute titans of the industry, and it gives me great pleasure to introduce to you my guest today. We have Andrew Rallich, founder and CEO of 10, Brendan Callan, CEO of FXCM, Mark Berkey, CEO of Swiss Quote Bank, Harpal Sandhu, CEO of Integral, and Matthew Maloney, CEO of CFH Clearing. Hello, gentlemen. How are you doing?
Good.
Very good.
Do it again. We appreciate being called Titans as well. It's a good start to the session.
Yeah, been called worse.
Exactly.
Thank you so much for joining me today and joining us at Finance Magnets Day. It really is an absolute pleasure. It's my first leaders panel. I've been really looking forward to this, hearing your insights, no pressure. And what a year to talk about. A record-breaking year for traders, COVID-inspired volatility in all asset classes, along with the cumulative effect of global lockdowns, brought in a significant upsurge in new clients, making a lot of you rich. What's been the greatest and biggest challenges your companies have faced so far this year? And that one's got Harpal, please.
Oh, yeah, great. Well, thanks for having me today. I hope everyone can hear me okay. It has really been an unusual year. I mean, in spite of all of the problems that the COVID has caused on a personal level for folks and sort of the lockdowns, I mean, it has presented, a tremendous opportunity for brokers in the market. I mean, there was a huge demand on their systems, on their services and requirements. So, from Integral's perspective, we're a technology provider to brokers. So we're not a broker ourselves. And so from our customers' perspective, really there were three things that were sort of motivating them through this process. The first was scale. We've had a number of customers that have had upwards of 300 or 400% increases in volume coming into the third quarter from last year, and it's just a big increase in just trading capacity, service capacity, and so on. So one was scale. The second was service level. I mean, they just didn't want their systems going down, and as you guys have probably read, in the last few weeks, in and around the election, even equity systems, particularly here in the U.S., in terms of some of the brokers' products, had gone down. So people wanted high availability. And third was cost, which is a big issue, because if their volume is going to double or triple, the last thing they want is for their costs to double or triple. So, we and a lot of the in-house development that people have essentially keep their costs fixed. So even though their volumes might double, their costs don't go up. And, so far so good. We don't know how long this lasts, but it's been an interesting year so far. And yeah, I think most of the people around this table and a lot of people in the industry have done well so far.
Anyone else want to crow about how well they've done this year?
Yeah, look, I think the years and years of investment in people, in systems, tech, it's paid off. It was a seamless switch overnight to effectively working from home. The volatility has carried us through. It's continued. It's responded fantastically well. I think as well, it's given people in the industry, our teams, our employees, a decade's worth of experience in 6 or 7 months. It's been a real steep learning experience. People have put on more career knowledge and development in this short time than they might well have done in more benign markets. So it's been a fantastic experience for traders and for employees.
Yeah, we're very fortunate. We're all in transactional based business and revenue models, and when volatility is up, transactions are up, and our revenue as companies and as an industry is up, and not everyone is as lucky as we are. Obviously, people in the travel industry and many others have been devastated by this, so we're very fortunate. Yeah, certainly I reiterate what Harpal said. Work from home has been a challenge. We went from a dozen offices to hundreds and hundreds of offices quite quickly, and making sure everyone had appropriate work from home setups. And we found out fairly late that a lot of our junior staff, a lot of the new hires, don't buy computers anymore. They do all their computing on phones, and that doesn't work for a work from home environment. So we had to rush order some laptops, and for the same reason, some of them don't get big broadband connections, and they need that to be able to work from home separately. So that was a challenge. Thankfully, we got over it quite efficiently. I think a unique challenge for all of us was in April with negative oil. None of us had processed negative commodities prices before, so that was a new one to everyone.
Yes, I agree. It was a crazy year, really, in terms of volatility. You know, we had these incredible market swings within one day. I remember a very specific day. You know, markets going 2 digits down and then closing by 5% up. You know, it was a challenge. We all did good business, I think, but it was also a challenge for our clients, you know, to cope with the incredible this incredible volatility. And then I think we're lucky that we are in a digital industry. I think many of our peers in bankings, say classic bankings, they did struggle because sending 90% of people home to do home office and then still having a company that is working. I think this is a challenge. I guess we all achieved this brilliantly. So it's but again, it was not only it may have been really good for us, but I guess that some of our clients did find this year really difficult.
Yeah, I guess to round off that conversation, that I think everybody on this panel and in the industry, we should all be giving ourselves a collective round of applause, and not just because this was record years in terms of volume, but I think the industry held up incredibly well as a whole, from brokerage to technology to liquidity. You know, there have been events, though more point in time, black swan type events, but there have been unexpected volatility and challenges that this industry's faced in the past, that we would spend the conference following those time periods walking through a graveyard of firms and technologies that didn't pass the test that was presented by the markets. And there have certainly been challenges out there, but I think by and large the industry held up really well, and that shows that we learned some of those tests of time. And I think I've often joked in the past that there are moments anybody who builds or operates technology in this industry questions, you know, why didn't I make restaurant software and I you know, be able to go home at 5 and know that I just need to turn the machine on at 9 a.m. the next day. I think we're all happy with some of those choices that we've made here and the way that our firms have stepped up to those challenges. We've really transitioned now, at least at 1-0, from, you know, what is this new paradigm to how do we deal with it? And I think a lot of firms and a lot of industries are now sitting here and saying, how long is this going to last? You know, in some areas of the world, our Australia office is back to business as usual and asking for a budget for their holiday party. I think I'd go to jail if I threw our holiday party in Massachusetts here in the U.S. Next week. So there's a question of, we know there's a paradigm reshift coming. How far will we shift back to what we knew as business as usual? And how do we adapt to kind of the continuing momentum of pressure that this just put on our businesses?
Yeah,
I think it's definitely the point that, sorry, I was going to, that there is that collective breath, holding the breath of seeing what's happening next. You know, you say about, you know, the return to the new normal. What is the new normal? You know, what is our business as usual now?
Well, I think we will see volatility also in 2021. You know, as there will be solutions for this pandemic. You know, and we have seen, you know, as soon there is a little bit of good news in the market, like the announcement of Pfizer recently that their vaccine is effective. You know, then you see this massive hope that things are behind us, and then the next day you get a little bit of disappointment. So, and then the markets are going down again. So I think we will have this kind of behavior, you know, high volatility, and also within the asset classes, swings in different economical sector. You know, have airlines surging by 20%, and then the next day going down by another 15%, just because you see the same news in a different light. So I guess 2021 will see the end of the pandemic, at least big solutions to help us overcome that situation. And then I guess once it's really behind us, we may see a big market rally, just because everyone will be so relieved. You know, there was hopefully a very happy moment.
You know, on this volatility thing, you know, it's something just occurred to me. while Mark was bringing up his point. You know, for a long time, when interest rates around the world went down, FX volatility sort of went down with it also, because there really wasn't a significant interest rate differential between the countries. And so FX itself, its volatility just, precipitously went down. In fact, it probably hit a low, historical low volatility in November of about a year ago. It really had hit very low levels. I think a very interesting thing happened when the pandemic kicked in and the central banks essentially moved all of their interest rates to zero. The initial observation would have been, well, if all the interest rates are zero and there's no interest rate differential amongst the various central banks, then you're really not going to see much of a carry trade or a lot of the historical reasons that people had traded FX. But I think actually a shift has happened, and the shift is really quite interesting. And that governments and portfolio managers who used to use interest rates or look at interest rates as a mechanism of controlling the speed of their economy or the growth of their economy no longer have that lever. That lever isn't there. So you may very well find governments using currencies and currency rates to look at the relative growth rate or how they might want to encourage growth within their economy versus another. And as that begins to happen, we may have FX volatility for the next few years while governments or central banks are required to sort of keep rates at essentially zero as the effect of the pandemic plays through. So, there may be all kinds of interesting volatility about, vis-a-vis vaccines and what will happen in equity markets and all that. But I actually think FX volatility will come in because there'll be a whole nother reason why governments and central banks are involved in the markets.
I think that I agree with Harpal on the point of pure market volatility. I think something very interesting that we've observed over the last 8 to 9 months is we got some volatility out of this year. Traditional market movement, FX volatility. If you look at the indicators that somewhat allow us to follow this, like CVIX, you see that it's better than last year. But when we look at our client base and when we look at the publicly available information from retail firms, the volumes that we're seeing out of them are being affected by something more than just volatility. And I think that's an interesting thing, especially for the audience of this panel and this conference to consider. We saw an uptick in pure market volatility in March. And historically speaking, as we've spoken on these panels or in this space, we've said volatility breeds volume. And we know that as the result of markets move more, people trade more. What's been very interesting for us at 1-0 is if you look at some of the major ECNs and venues that are primarily driven by institutional trading volatility, their flows are up from last year, but they're relatively flat and subdued coming out of March. Whereas in retail, we see this sustained increased volatility coming out of the initial stages of the pandemic. And what we've tied that to, and I think a very interesting analysis and data-driven discussion to have is account opening. I'd be interested to hear, we're a technology provider, so we don't have direct clients signing up with us, but our hypothesis at 1-0, and given our very broad swath of servicing the retail space, is there are more people with the ability to work at home, with the ability to engage their job, not from a desk and in an office, who are opening accounts and who are thinking about trading on a speculative basis to fill some of the gap of time that was originally put into a commute or something similar. So in addition to looking, of course, we're focused on economic policy and how volatility is going to affect us in 2021 and beyond. Where is that account opening trend going, and how do we sustain it and keep these at-home workforce who have decided to speculatively trade and who have added a third component into that volume volatility equity on deposit equation that I think is going to be really important for this industry to sustain the positive momentum out of 2020.
Yeah, I agree, Andrew. And I think part of that drive as well is that the pandemic has led people to think that they want to take perhaps a greater control of their finances, their destiny, their income. They want diverse sources of income. And so they are looking at some more speculative assets. And the way that we can continue to encourage these people and develop the business is by giving them more products, more offering, greater number of products all in one place so that it's capital efficient. I think that's a trend that we will continue to see. It's opened up the industry to a lot of people that perhaps previously wouldn't have considered it as a way of earning a living or Yeah, a way of diversifying the risk.
This point you're bringing up, Matthew, is actually spot on. I mean, if you look at any one of these complexes that exist, whether it's the equity complex, the futures complex, the FX complex, the interesting secular sort of growth shift that you see is when any one of those complexes expand the number of risk products that people can use while keeping their capital with the same broker. So if you think about equities back in 2000, late 90s, early 2000, the invention of the ETF was a really fascinating phenomenon because it allowed people to keep their money with their equity broker, but actually trade risk units that were further afield than the single stocks that they were involved in before. In fact, an interesting number, I mean, you guys probably know this, but there are more ETFs traded in the United States today than there are actually stocks. I mean, actually more ETF products than there are stocks. So the idea that you could keep the capital in a single place, but then actually speculate on oil, speculate on gold, speculate on the stocks themselves, speculate on indices, actually encouraged people to keep their capital there, and exactly as you say, capital efficiency. Then you look at what happened in the futures market. You know, so when the futures exchanges offered people futures on FX, futures on various types of commodities, futures on various other kinds of indices, and then after Dodd-Frank, futures on swaps, futures on various types of interest rate complex products. In fact, they bragged that they were futurizing all of these different OTC products, and the reason people liked it was they could keep their capital with their same FCM and then trade different risk products. I hypothesize actually something very fascinating is going on in the FX market now, and I don't know what the term we should use yet, but where futures exchanges, listed derivatives exchanges, futurized various OTC products and brought them over from the dealer markets to the listed exchange markets. I think there is some phenomenon going on through the use of CFDs or for the use of, interesting, and I don't want to use the word for regulatory reasons, but essentially derivatives, rolling spot versions of risk units across a variety of different asset classes where customers can keep their capital with the same broker, but trade across those asset classes. The same phenomenon is happening here. And I would put it to you that in fact, FX brokers around the world have the largest footprint, the most sophisticated systems, and have a variety of risk management models, both trading on their own behalf and acting as agent on behalf of the customer. Where of the three complexes that exist, it is actually the most interesting complex and maybe the one I would put forward have a reasonable chance of actually winning the capital race or the capital competition for those individual traders as to which form of organization, which form of broker they're going to keep their capital with.
On the volatility front, so we launched a volatility ETF. We call them baskets because it's OTC, obviously. And to get a little meta, the volatility of the volatility index is up 50% over the past few weeks, which means the market's whipshawing and then settling, and then whipshawing and then settling. And I think as far as new norms, we anticipate that being thematic for the coming year or so, where the markets will go crazy in a specific, as an example, oil or in the Dow, or everyone's playing these kind of work from home plays of Zoom and Peloton and things like that. You could short them or long them, whatever you think is going to happen in the COVID situation. Yeah. So as far as businesses kind of dialed into that, we need to be able to pounce where the volatility is when it's there, get the customers on board, and then work on engagement, when volatility levels back off again, and be ready for the next spike wherever it may be.
That's it. You never quite know which one of these instruments might pique somebody's interest, and all of a sudden they come on, they trade, and then they get excited about other things. So having that product suite all in one place, all nicely cross-margined, that's absolutely the future.
I fully agree with Harpal. I think more and more transactions, more and more flow will be going off exchange. I think the benefit the exchanges have brought to the financial world and the tradable markets is dwindling. Obviously, the counterparty exposure was the big benefit, and that's really coming down to technology. And they don't have better access to technology than we have.
Yep.
Mm-hmm.
So I certainly anticipate a trend going forward, not just 2021, but beyond that, is that more of this volume will go off exchange. We don't charge for data. You can get that free. That's one hurdle right off the bat covered.
Mm-hmm.
Our transactional efficiency is just as good, if not better, than the exchanges do. So
Brendan, I think one point to an earlier point that you made that's really important here is what does this product suite look like on a go-forward basis? So when we went through negative oil and contango over the summer, I think one thing that we realized is not all derivative products of an oil future or spot representation of a futures contract are created equal. And we have kind of an interesting divergent approach at 1.0 right now in how we're working with our clients to solve this. On one hand, we've released a module into our product where brokers can custom develop and code in using inputs from the market data streams, also interest rate information, and build their own CFD products custom themselves. But at the same time, we're trying to work with the array of prime and other partners that we have in our ecosystem to understand if there's value in standardization. And I don't, this monologue doesn't culminate in, I have the answer for this. I think we have interesting challenges as leaders in the industry to say, is the way that we construct our spot oil and remove the basis, is that value-added intellectual property within my offering to my clients and its uniqueness is therefore marketable to me? Or is there value in looking towards standardization within our industry across how we build these derivative products or rederivative products, and being able to do things like aggregate them, standardize them, make it more seamless for clients to understand what's going to happen in contango, not what's going to happen depending on which broker they're trading with and how they've decided to construct their product.
Yeah.
I think 2020 has seen an evolution of the trading industry in terms of a new generation of trader. None of you mentioned the zero fee stock trading, the Robin Hoods and their impact upon the industry. I mean, how has this impacted the industry, and where is this taking us?
We've been zero commission for decades. So in some sense, they're kind of padding our marketing budgets. Getting zero commissions out there, is a good thing. It's not new to us. Their business model obviously relies on payment for order flow, which was disallowed under the FCA's regime, I think in 2012. So their entire business model is based on something that the FCA has deemed illegal because the conflicts of interest are insurmountable.
Yeah,
so
that's probably
yeah.
That's probably the reason why Robinhood they cancelled the launch of their application in the UK. I think that's the news that broke in mid 2020. And FCA is one thing, but now in Europe we also have MiFID rules. They're very strict, and this as you said, this pay for order flow business model is really a tough business model in Europe. It doesn't really work, and we do have a deep discount broker, obviously, many of them, but when you look at their performance, that's not that great, and usually there have been a major merger among two deep discount brokers in Germany, but that doesn't make their business model even sexier. So it is tough on the equity side. And as you said, I mean, we don't charge commission when doing forex and CFDs now, but that's not something you can envisage on the equity market.
No.
Yeah,
I think technology gets more scalable, so there will always be a degree of fee compression. But actually, customers are pretty savvy. They realise there's no such thing as a free lunch. All of that client service, the IT platforms, it's all going to be paid for somehow. And so customers are intelligent. They can work this out. It's not free. Then they start to look at the overall service offering, and they can quickly gauge where the money is being made.
Yeah. Although, I mean, having said that, you look at the U.S. equity market or equity brokerage market is a really fascinating market. There was a time around the dot-com boom in 2000 when there were lots of new entrants, new startups. E-Trade started at that time and so on. And they were viewed as extremely valuable companies because of growth rates. Post, the financial crisis and other things, it just fell out of fashion. So the number of firms that were involved in it sort of decreased. The commission rates as a percentage of the overall value started getting higher and higher. So Robinhood's entry in many ways was just timing. They offered a product that looked less expensive to a new generation of traders that hadn't previously been marketed to. And so they had extremely high growth for a period of time. And that growth translates into very, very high market value. I would actually submit, just as Mark and Brendan have already stated, that in many ways these unregulated markets or lightly regulated markets of FX innovated on customer value propositions long before regulated equity markets within the U.S. did. So the idea of payment for order flow isn't new. It was newly introduced in equities because people were just sort of complacent. The brokers were complacent in terms of the offerings they had. FX innovated a lot faster. I would also bring up the one more thing. Robinhood takes no risk. And it's a really interesting perspective from a Robinhood's investors' standpoint. For all the volume they do, they're essentially making a fixed fee on that payment for order flow, assuming that the value of that order flow remains constant over a period of time. They have very, very little volatility in their dollar per million earning amount or their yield amount. And that is extremely attractive to their investor base. And there's been an ongoing discussion even amongst the FX brokers for those that have either gone public or attempt to go public as to what the investors will apply in terms of a multiple to their business if their earnings are a bit more volatile because they're internalizing flow rather than doing, in Robinhood's case, sending it off to market makers and just getting paid for the flow.
It looks like the model of Robinhood is now becoming the standard model in the US. I think all the big competitors of Robinhood has adopted the same price strategies. In Europe, also don't forget the market is super fragmented. It's easy to get good money out of an order flow when everyone is trading more or less the same securities. But in Europe, every country has its own local champions, and the retail, which is so interesting for this order flow, they do trade their local stocks. So that's maybe also a little bit the difference with the US.
Mm-hmm.
Staying with the US, the election results are in. Congratulations for making Israeli politics look sane for once. What changes can we expect now in what has been a burgeoning FX market in the US? We reported record user acquisitions in Q3. What can we expect now?
Well, I think the Senate will most probably stay Republican, and even though it would just be a 50-50, I think the balance of power in the U.S. in this special configuration will not allow President-elect Biden to have a very leftish or liberal economical policy. So I don't expect many things to change from that standpoint. I don't know if my colleagues would agree on that.
I think there's such an enormous domestic agenda focused on Corona, focused on trade wars. That was the big thing before Corona. That actually there's so much to be done that I don't see any rapid, immediate changes. I think it'll be business as usual for a period of time.
Although I think the probability of really significant change is low, there is a particular path that could be taken that would lead to real change. So two things have already happened, right? So Gary Gensler, who was the previous chairman of the CFTC, has now leading up the transition team related to Treasury. Gary Gensler was a huge advocate for Dodd-Frank, and if he had his way, the regulations that were actually written that came out of Dodd-Frank really would have gone a lot further in terms of mandating to trade, mandating to clear FX outrights, forwards. They would have done a lot more work on FX swaps. I think it'll significantly affect the ability to roll spot FX and not call it a derivative. If Gary Gensler and Biden's team appoint Democratic leading and Elizabeth Warren supported CFTC commissioners. So that will happen over a 4-year period. It won't happen immediately because those commissioners have terms, but that will happen. And it has nothing to do with legislation at that point. It just has to do with regulations, rule writing that'll come out of the CFTC. The second thing is that Elizabeth Warren may be selected to become Treasury Secretary. And then I think you're going to have, I mean, radically different positions, again, from a regulatory perspective and an oversight perspective of bank capital requirements. So it could be there. So we'll see what happens.
Andrew?
I knew you were going to come to me. Living in the US here. You know, what's interesting about our political system is you can have these new federal regime changes. I for one, and I think I'll recognize Harpal, you know, said low probability. I don't necessarily feel that Biden's going to get the progressive cabinet that some people are predicting across the line, or that's not really his agenda. But what's interesting here is these changes not only happen at a federal level, but can also happen at a state level. So the concept of a transaction tax is not new because somebody on the left side of the aisle is now sitting in the president's seat, or there's been a slight shift in power in the Senate. The state of New Jersey has been approaching a transaction tax and teasing it for some time now. And this creates a subtly different type of interesting phenomenon. So it doesn't necessarily mean a fundamental shift in spreads or structure of how swaps are treated as a derivative, but it would make banks and exchanges and everyone look at Equinix MY4, what has been the beating heart of this industry, at least on this side of the Atlantic for the last decade or more, and question whether or not that where business is transacted at a fundamental counterparty level would shift to London or Chicago or somewhere else. That would create a lot of upheaval for our industry. The thought of what a change in transaction tax or treatment of swaps or forwards would do to retail is you have to go through a lot of levels of what that would do to spreads, how they would recompress, how it would eventually get to the client. What New Jersey specifically becoming an unattractive place to run your business would do is create a tremendous amount of disruption, simply moving hardware around to follow the liquidity and remain co-located, but dodge a state level mandate. So
yeah, but I think all of these things are risks. If rolling spot somehow is treated as a derivative going forward, you're going to have PBs exit this industry. Okay, and that's going to be a big deal. The same way PBs aren't involved in CFDs, there could be a big issue of big tier one banks, you know, offering PB services. But you know, there's risk all around the board. I mean, the U.S. election is one thing. I mean, what's going to happen post Brexit? You know, what do we do with our FCA licenses versus our EU-based licenses, passporting? There's still so many issues, you know, open there. I just think we don't know. And I think any firm that's going to be involved in supporting customers in multiple jurisdictions has to have the flexibility in their platforms, whether they be their legal platforms or their support platforms or their physical technology platforms in terms of where they're doing the matching and what service providers they're using, where their data is located. All of these things could be called into question in the next 12 to 18 months, every single one of them. I mean, who knows what Turkey does? You know, with a new finance minister, and whether they make requirements of keeping the data within Turkish borders or allowing those servers to remain in, you know, in the UK or Switzerland or what have you. So all of these are going to be issues. And if people aren't flexible, they could get caught flat-footed. They could get caught being excluded from certain jurisdictions. But you know, I'd say this industry again has shown much more resilience than most other industries in terms of reacting to this and reacting pretty quickly. So I think it'll be there, but I think this group will do really well.
I saw Matthew wince. I think the Brits was hoping that Trump made the world forget about Brexit. I echo Harper. We still know that it's out there. We still know what's going on. It might be the most embarrassing thing going on in the world again soon.
What is happening with Brexit, though? What is happening? We've got a no-deal Brexit coming up. Matthew?
Well, so look, there could be a no-deal Brexit. We may well not know until the 31st of December. That said, we're in a very, very fortunate position in CFH. We've got global licenses. We have licenses in Europe, licenses in Asia. So actually, we've already got the process, the procedure to start to move customers around if they request, as we need to meet regulatory requirements. And I think one of the trends that we will see as a result of Brexit, whatever form it takes, is a lot more M&A and potentially a lot more coalescence around those big players that have got the scale, the bandwidth actually to perform at multiple levels in multiple jurisdictions. The days of being very closely regulated in one type market and hoping that works globally, probably gone.
Yeah, I agree. I mean, I went yesterday through the list of authorized companies in Italy, and with an FCA only license. And there's pages and pages and pages of firms that are active in Italy. And I think I'm not 100% sure whether the industry has realized that even there would be a deal, a last minute deal about Brexit. It's very unlikely that the UK will be able to retain its passporting of financial services to retail clients. You know, there may be some form of an agreement what financial services is concerned, but the fact that the UK only licensed company will be able to sell its products in continental Europe, that's probably not going to happen.
Brendan?
I mean, in this respect, this would be a big plug for, cloud computing. Cloud computing is fantastic that way. I mean, we have customers who had mandates to keep data, to keep matching happen within a certain jurisdiction. And that was a less than a 24-hour, switch flip that had to take place. I mean, customers were completely uninterrupted. They had no difference. There was no cost structure difference for the brokers. They merely allocate their trade flow, their matching to engines in one jurisdiction versus another. Now, the regulatory and the legal oversight is a whole separate issue.
Yeah, you need to be regulated somewhere, So the thing is that most of the companies have got organized, at least the bigger ones, and having license in other jurisdictions in Europe, so they can move people around. So it's less about data rather than being regulated in the right place.
Mm-hmm.
I will note, Mark, Amazon is offering EC2 space in satellites at some point in time, and I do predict that this industry would have an interest in maybe operating an exchange and matching engine up in space. But yeah, I agree with you. In a
One space global financial space regulation, that would be fantastic, right?
Well, where you're regulated depends on where you want to serve people. Right now, I don't think the audience is very big out there, or at least not ones that I want to sell to.
Yeah, we never know. Elon Musk wants to build one colony of 1 million people on Mars. So, financial services will follow.
Yeah.
Depending on what.
I think lots of other regulated things will come there too.
Yeah. I mean, staying with regulation, it's we've seen. I was looking back at the last leaders panel, and it was talk about the offshore exodus, the brokers for the offshore exodus. And this year, we've seen a lot of heightened regulation, especially in Australia recently, Bahamas. Where is this trend going? Brendan, so I'd like to hear from Brendan. I haven't heard your sultry voice for a few minutes.
Oh, I'll try to be extra sultry then. ASIC is the last of the major regulators to do it. So it's already the case in the US, in Europe, in Japan. So, back to one of Matthew's previous comments, I hope 2021 is a year without massive regulatory headwinds for this industry. I think all the big ones have fired their shots. I think the no debit guarantees was necessary. I think, none of the marketing nonsense as far as the top up bonuses and things that, encourage a lot of churn for brokers that kind of bucket shop their business models. I think those very positive forward steps have been made. So, I'm optimistic that 2021, they'll be focused on other things, and I would far sooner speculate in the FX market than in the political ones. But, I'm certainly hopeful. As far as Brexit goes, the only responsible thing for firms to be doing, and has been the case for the past year or so, is assume an absolute no deal Brexit. So that's what we've all done. And we've aligned, ourselves to make sure we're prepared for that. I think unfortunately the downside of Brexit will be most prominently bared in the UK. I think UK financial services entities have a high cost structure just by the way of the fact that the UK regulator is an onerous one to be regulated under. The capital requirements here are high. I'm talking to you from London, by the way. And the corporate governance requirements are very high. And when that cost structure is only supported essentially after Brexit by UK resident revenue, the math won't work out for smaller firms. Yep. And I think there'll be a massive consolidation here in the UK, which is a good thing. I don't remember who said it, but I think this will drive consolidation across the boards to the bigger firms where the math still does work.
Yep, absolutely. There will be a wave of M&A activity, and we're all likely to be beneficiaries of that because we have all got well-capitalized big shops.
Do you think London can remain an epicenter of the financial world?
Yeah, I think
it will.
It's not just financial services. It's everything that goes along with it. It's English law, which forms the basis of a lot of law globally, and it's still the predominant contract law. It's the English language, it's the legal skills, it's the sort of finance, the M&A, everything that goes alongside it. So there's an ecosystem that serves the world there.
Yeah.
So irrespective of what regulation or what form Brexit might take, there will still be a desire to harness the sort of intellectual bandwidth and the capital markets of the UK.
Yeah, and don't forget, Matt, there's something unique in London, which is this huge skilled workforce. I think this is the only place in Europe where when you say you need 100 people by next week, you can have it. Try to do this in Luxembourg, it's almost impossible. So I mean, only for that reason, London will stay as the biggest financial hub in Europe, whatever happens with Brexit.
Mm-hmm.
To add in from the technology side, I think to Brendan's point, we agree. The major regulatory swings in jurisdictions that have been hotbeds of the retail brokerage space have very much fired their bullets. We still predict an increase and kind of never-ending demand for regulatory reporting enhancement. That's one area where we continue to see the regulators ask for more and more and more in different formats. And that's an area where we've invested a lot. We have a very wide swath. The benefit of being a technology provider in that we don't and are not regulated in a specific industry, but we service this whole industry, and regardless of where you choose to position your brokerage, we need to be able to respond to those demands. Our investments from a regulatory perspective these days are mostly in getting data into a accessible format. We've built what we call the regulatory Rosetta Stone up in the cloud, and taking it one step further, we've recently announced that we're actually now partnering with third-party regulatory vendors and training them, allowing them to understand this data. So as brokers move around between jurisdictions, it's not a full onboarding cycle. They can be much more agile about new data demands or a shift in their primary regulator, so that that's not disruptive to their core business. And I predict there's just going to be a continued ask for more and more data in different formats that as technology providers, we need to be ready to service.
Yes, I think best example to illustrate that is the last move of FINMA in Switzerland. They just decided that FX/CFD platforms are organized trading facilities. So the biggest change there is that the need and the audits and the data that you have to provide will just become huge. That's and I think what Brendan said is absolutely correct. The regulators are all merging in the same direction. So I don't see the regulations becoming much more tightened in the next months, because more or less we're there. We are at the same level all over the world now, which maybe is good. It keeps the dodgy players out, and only the serious will survive, which offering serious business and not relying on super high leverage to do their business. I mean, that's probably good for the industry on the longer term.
Brilliant. I mean, we're getting close towards the end of the panel now, unfortunately, but there's something that personally I would love to hear from you guys. So I watched the last panel. You've said about how you've been planning for no Brexit. I mean, you guys are the leaders of the industry. What are you planning for in the next year? We've got, say, no deal Brexit, changing US administration, a pandemic. What are you planning for next year?
Sorry. Should I start? Okay, sorry.
Go for it, Mark.
I think the world got a digital acceleration, with COVID, and we all turn digital. You know, like just the panel we're doing here online. You know, it's now becoming so easy. You know, it's becoming standards, and then everyone can work from home, have, you know, the digital tools now becoming just part of our daily life. And I think that will change a little bit our industry as well. So one of the changes that we have massive new clients, because they say, you know, if I can do a Zoom call, I can also do the wealth management online, is as easy as that. So what we are getting prepared for next year is to just, you know, more infrastructure, because the market is turning in our favor. The digital revolution is really happening now, and also what we have to be ready for is, you know, the threats of on the infrastructure. I think many of us and our firms has got DDoS attacks. Sometimes in their corporate life, and this will also become some kind of a norm. So we have to get ready, you know, to not be disrupted by those by this type of events.
Yeah, I echo that, Mark. Whether it's a pandemic, an election, a whole new bunch of clients, all of that ultimately leads to greater demands on the technology and the people that we have in our businesses, and so it's making that scalable.
Yeah, I think nothing as far as the pandemic or the political world has changed our business model. So it still is more, bigger, better, faster, and we have to keep innovating. We just released updates to our mobile apps and our web trader platform, which we're really excited about. We're putting new baskets, the equivalent of these ETFs, out into the world, which is great, so people can take a speculative position and mitigate some of the single firm risk. So we have a work from home one coming out. We've got esports, we've got biotech, we've got travel ones coming out. For people that, you know, can't seem to settle down during all this craziness, we even have a cannabis basket. So if that's to their liking.
Yeah, everyone as well.
I like Brendan's way of saying it. I mean, and I follow that theme: more, bigger, better, faster. So added a few more positive terms onto that. You know, I think it is going to be more of the same. I actually think that the capital that has moved into, whether we call them, you know, FX brokers or whatever, this whole FXized, you know, rolling risk units across all these various asset classes. It's an extremely efficient place for people to keep their capital and trade in one place and reuse it. And I think that's going to expand. I think it's going to expand on a global basis. I think there'll even be some expansion here in the United States. There are new entrants now coming back into the U.S. market. So with that, I think a lot of you know, the infrastructure that supports that. I mean, at some level, people can run things centralized. At some level, they have to run things decentralized when it comes to you know, data location, regulatory reporting, you know, legal entities. And I think the best firms are the ones that can leverage off partners effectively to have as versatile, as flexible of a global footprint to service their customers everywhere in the world and in the most efficient, optimized way possible. And I think technology and cloud technology really allows people to do that. And although I agree with everybody that the smaller brokers will have a much harder time when a lot of these changes take place, the smaller brokers have, I mean, a significantly easier time today with the introduction of technology, you know, cloud services and so on than they did, you know, 10 or 20 years ago. And I think that's a natural evolution of this space also. You know, people may become very, very good at marketing and at advertising and at various other portions of the food chain without having to be the entire broker. And I think you'll see some change in that respect also in this in the next couple of years.
Yeah,
best to last, Andrew.
Thanks. Thank you, Ben. I couldn't agree more, especially in terms of the role that technology will continue to play in facilitating the answer and thought process around this question of how long and what is the new business as normal. So I mentioned servicing the industry before. 1-0 has hundreds of clients and not only brokers that operate in this space, from small to some of the largest brokers in the world, but also a very vibrant network of prime providers, of market data vendors, of regulatory reporting vendors. And what's interesting about this paradigm is just like a lot of us have gone through reorganizing and rethinking our meeting and employee structure to facilitate remote work and collaboration. This is an area where we're really focused within our network and with our technology. How are we getting our clients to be able to communicate with their liquidity providers, have data-driven conversations without sitting in the same room? And data and multi-asset capabilities have been an investment theme for us for a long time. In the how long and what is the new world phase of this industry and the global economy, it's all about facilitating good partnerships, good collaboration, good communication on top of, we can't really sit in the same room or fly to conferences together. Though I do hold out hope that we'll be seeing each other in person sometime in 2021 and look forward to that if we can make it happen.
Absolutely.
Amen. Gentlemen, thank you so much. I'm getting the wind-up message from my colleagues. It really has been a pleasure, thoroughly illuminating, entertaining. Again, thank you so much for joining us, joining the Finance Magnets Virtual Summit. All the viewers, this will be available online. See the website for details. Thank you and goodbye.
Thank you, Ben.
Thank you, Ben.
Right. Bye.